Everyone. What's up? Thanks for uh thanks for signing up for our last session. Some of you guys signed up on YouTube. Let me make sure I rearrange this stuff. Maybe sometimes this kind of like screen share thing works fine. Sometimes it lags, and if it's lagging, just let me know. But yeah, thanks for signing up for our session. I there we started doing these webinars from time to time on our YouTube. Usually doing this from our studio, but I'm in our New York office today, which doesn't have a studio. But yeah, today we're going to talk a little bit about how funding works and walk you through that process. I see a bunch of you guys on the YouTube live stream. Hi, it is a live stream. It's not a pre-recorded thing. I see some of you guys signed up for the Zoom. Sorry, like I know that we were scheduled to do this yesterday, but our it had some travel complications. Let's just get on it. Uh, I have like 30 minutes of slides, and then we'll have room for all the questions that I can get to in the span of the remaining 30 minutes. So let's do it. So the first thing I'll clarify is, people tend to think sometimes I'm Slidebean. I'm not Slidebean. My name is Caya, and I am one of the founders, and I'm the CEO at this company called Slidebean. And we do a bunch of other things other than YouTube videos, which happen to be mostly our side hustle. And the biggest thing that we do is we help founders just navigate the process of fundraising, which is not easy, and we're going to talk about it. Hey, Nico, I see your comments. Glad you like the videos. All right. So raising money sucks. And, we're a venture-backed company. We raise money ourselves. We've been through this and it sucks. So let me talk about it and let's see if I can help. So the first thing I see so many companies, and I include myself in this boat, the first thing I see a bunch of companies struggle with is this idea that, funding feels like the end goal, right? Like we spend so much time, my company is literally a company built around funding, and so much of the process of raising funding feels like the goal, like what your startup is about, because we have to spend so much effort and learn so much shit to do it. But we should never forget that funding is very much just a means to an end. It's just one step in the process. And sometimes, like I see founders kind of, man, like restructure their whole company around the possibility of funding, when in reality, you should be looking to build a business. But not only that, if you're looking to raise money from venture capital investors, then funding is not just a means to an end. Funding is the means to the end, which has to be either selling the company or going public. Like that's the only end game that will make a venture capital investor uh, happy. Like it'll make their money's worth. So I guess the question that tends to come up when I say that is, well, how about profits, right? Where do profits fit in here? Do I ever need to find a path to profitability? Okay, so let me give you an example about that. But yeah, by the way, if you questions come up on the way, I'm decent at multitasking, so throw them in the chat, throw them in the Zoom chat or the YouTube chat. I can get to them. If you want questions, kind of like broader questions towards the end, you can throw them in the Q&A thing, and then or you can just hold off a bit. Okay, so let me give you two classic company scenarios. This company that is looking to raise $1 million in funding, right? Maybe not a crazy number that you've thought of as the money that you need to start this business. Okay, and maybe you thought that you kind of wanted to give investors something like 15% of the company because you figured, yeah, like you want to retain all this big pie for yourself. So yeah, let's just give investors 15%. So let's see how that could play out if you were to build company type one, which is a profitable business. So let's say that you make this deal, it happens. Investors give you $1 million in exchange for 15% of the company. You don't raise money again because you're looking to build a profitable business, and then you do really well, and you transform this $1 million investment and this business idea into a $10 million company, $10 million in annual revenue. Exciting. Okay. So what happens next? Well, companies in general, companies tend to operate on an EBITDA margin of about 10%. Right. So like think after everything, after your costs, think after your accounting team, and think of everything, all the operations, all the overhead, all the marketing, everything, company that does well, like operates in a 10% EBITDA. There's R&D that you need to spend. There's staffing and office and all that. Okay, so 10% EBITDA is standard. Now, if you take off taxes in the US, it'd be 20%. So if you take corporate tax after that, not to mention state taxes, but you might end up with, say, $800,000. So it is $10 million that the company made, $800,000 are profit, which sounds really exciting. But remember that investors only have 50% of this business. So you go out and you distribute dividends. You take all of your dividends, which also doesn't happen that often, but let's assume it does. Take the full $800,000 and you distribute that with dividends, and then investors end up with about $120,000, which is the 15%. That's before taxes. Now, investors, whether they invested individually, they still need to pay taxes on that, or they might need to. So basically, you've put in $1 million. If this business succeeds, becomes a $10 million business, you're looking at 100K in profits per year, which means that it's going to take about 9 years after the company reaches $10 million in revenue to be paid back in full. That's just to be paid back, right? That's before the investors make any returns. So that's not exciting at all. And I think that there tends to be a lot of confusion on this because you hear these stories and you hear all these companies that raise all this money, but it doesn't, like, they don't think about this potential return for investors and or how it might happen. So ROI is non-existent or just takes too long. So that's not great. Okay, so let's look at another example. Let's look at company case number two. So same idea. Company case number two goes on, raises $1 million. It gives investors 15%, but this is not a company that's looking or that's prioritizing profits yet. It's a company that's looking to grow. So they go and raise another round. So that means that the money that they raised from these investors, so the equity stake that these investors got shrinks because there are new investors, right? And that everybody gets diluted as new investors come in. So they might end up with less than the 15% they got originally. They might end up with 12. That's fair. Okay, but this company, because they didn't prioritize profits, because they were just full on aggressive, risky growth, they pushed through and they got to $50 million in revenue. No profits. It's not a profitable business, but it makes a lot more money. It's a much bigger TAM, bigger stake, bigger percentage of the market that they own. Okay, so what happens? Well, what we aim for, right, in startups, which is a bigger company acquires this. Bigger company sees the potential, thinks that their product or their technology can integrate really well with what they do, and they'll acquire them for say 250 million, 5 times revenue, which is not a crazy number by any means. It's, I think, a pretty standard, um, not a pretty standard, but an exciting startup valuation, but a normal, not crazy, not kind of like unicorn type of exception. But this is 5 times revenue is a way growing tech companies get valued. Growing, right? If it's still growing, there's room to grow. Okay, but what happens here? Well, this company got acquired, all the equity, all the current founders and investors got bought out. This 12% suddenly translates into $30 million cash, right? Paid upfront, paid what in year 7, let's say. So it's a 30 times, 30x ROI on their $1 million investment. And it happens just 7 years later. That is the definition of venture capital. That's why investors are willing to put tens, I was hundreds or thousands of thousands, hundreds of thousands of millions of dollars in startups because there's a possibility of this 30x return on this company in a very short span of time. Not profits. It's exits that these investors are after. So this 30x ROI in 7 years, not easy. It's a super risky approach. You need to be growing. You need to be growing really, really fast. That means spending a lot of money. That means probably you're not going to be prioritizing profits anytime soon. You're going to need multiple rounds of funding. But again, the end game, the way people get paid for this is with an exit. I see your question, Pigeon Post, but let me carry on and I'll remember. Okay, so that's the game that we're in. So again, funding in this part is just really a means to an end, right? It's just one step in this process. But we have to see it through. We have to go to the end of it. Okay, so how do we deal with this? How do we understand funding, startup funding, and how do we understand these rounds? Well, we established that now funding is really a bridge to another round of funding, right? You're always looking to you're probably going to have to go through multiple rounds of funding to reach this end game, which is selling the company eventually. Um, Ship, sorry, almost threw my laptop. Okay, and this is these rounds of funding. This is what we tend to define as starting rounds of funding. And there's this pretty standardized naming to them. A standard tech company goes through pre-seed, seed, Series A, Series B, alphabet series, and then hopefully reaches that exit point. Now, biggest mistake uh, people make, and the biggest misunderstanding we have around this is that seed is kind of like this thing that happens here at launch, where you launch a product and you immediately can think of yourself as a seed company. That's not how it works. Um, a seed company is a company that's actually much further down the road. It's a company that has somewhere in the I like to say $20,000 to $30,000 in monthly revenue. If you're a SaaS company, $20,000 to $30,000 in MRR. If you're social media, maybe you can get away with less revenue, but definitely really exciting, tens of thousands of users, double-digit monthly growth. It's a really exciting company that gets to raise a seed round. Seed rounds in this day and age tend to be $1 to $2 million, which means that if you're raising a seed round, that means you launched much earlier than that, right? You launch somewhere between pre-seed and seed. Again, big mistake companies make. They launch and they think of themselves as a seed company and they go pitch seed investors, which are always going to say no because, not always, but most of the time will say no because seed companies are much further down the road. And again, when you raise a seed round, you're kind of looking, you have to make sure that the money that you raise is enough to reach the next fundable milestone and go raise the next round. In this case, Series A. The Series A round is normally raised somewhere in the $2 million in annual revenue. Now, notice that I'm talking about a standard tech company here. It's a standard tech company. I want to say SaaS products, marketplaces, software that where you're taking existing platforms, using AWS, using some existing APIs, maybe plug into OpenAI or some LLM, like a standard product that tech product. Most apps, most tech products are standard tech companies in this by this measure. There's another type of tech company, which is what I like to call the R&D tech company. There's maybe a biotech startup that has a patent on some new CRISPR DNA editing thing, or some new cancer treatment, or what's another example? Oh, like say you're building like your own large language model. I don't know why you would do that now, but you're building your own LLM, your own AI from scratch, right? So this is not going to be a one. Is you're not going to have revenue after your pre-seed because you need 5 years of R&D to come up with this thing, kind of like OpenAI, if you think about it. Right. So that's what I call like an R&D tech company. It's not a standard term, but let's make that differentiation. And in that case, launch doesn't happen at seed, right? Launch may happen further down the line. Hardware companies are another good example of R&D tech companies. They're building, I don't know, like that AI pin thing. Those guys raise multiple millions of dollars before they launch because they have to go through supply chains, through product building, and so on. So it's a whole different story. Not, I mean, the founding team that you need to raise money for an R&D company is very different, right? You're probably looking at probably some PhDs need to be thrown around in there into the mix of founders in order to raise that. Probably some existing IP, maybe some college stuff, college patents, stuff like that. But yeah, different ball game, and I wanted to kind of make that exception. Okay, let's get back to the standard tech company. So let me walk you through, robotics. I see you, Dan. Robotics would be a perfect example, right? So you need a lot more money to go through this R&D. But going back to standards, right? We're talking about funding rounds. We're talking about milestones. I think the milestones idea is very much uh, sorry, Mohammed, marketplace company. I'd say that that's a pretty standard. There's no big R&D there. Your software, the software to launch a marketplace, your website or your app, you can build that in weeks, maybe months, but it doesn't require years of R&D. Hey, well, I see you on webinars for R&D tech companies. I'm not an R&D tech company, so I don't know enough about that to talk about it. And I'm very legit in the sense that I only like to talk about stuff that I really have been through or understand very well. I honestly don't understand R&D tech companies in order to like become an expert in it or pretend that I'm an expert in it. So, no, I know a little bit about it, but I've written some pitch things for these companies, but So let's go through these rounds and let's understand kind of like what's between them, right? What do we need to do to get from one to the other? So let's talk about this first step. Maybe a bunch of you guys are, and I'd love to know, like if you're pre-seed in either group, Zoom people or YouTube people, just type in pre-seed. That way I'll know. Uh, okay, but let's say pre-seed to feed, right? What's a pre-seed company? What's a pre-seed company, and how do we estimate this raise, right? We establish that launch happens in the middle, so we have to raise enough money to not only launch but get to that 20K metric of seed stage, right? So a pre-seed company is a company that has a fully formed team, founders that have all the core skills to build this product, and you should have some good ideas of how you're going to get to your first 100 customers, right? Um, why? Because as you pitch these investors, part of their money is going to go through launching, right? I see the first pre-seed case. See, in the seed stage, should we wait until we reach 20K MRR before approaching seed investors? Yeah, Norbert, I'd wait. Like I normally don't want to pitch investors ahead of time or too far ahead of time. Because what you're going to get in return is, well, yeah, come back when you have blank revenue metric. So yeah, okay, fully formed team, etc. Now, and then the money that you raise again needs to be enough to get to seed. So what's seed, right? Seed is a company that has a product in the market. Ideally, it has 20K in revenue or more. It's growing fast, it's exciting, 10% monthly growth. I'd say it's good, maybe 15. And so basic understanding of your growth metrics. It's such a double-edged sword. Founders sometimes go and say, oh, we have all these customers and we did that with $0 in marketing. It's like, well, I mean, that's good, but it's a double-edged sword because maybe you don't understand your marketing channels very well. Maybe you got a little lucky with some PR, but can you replicate that again, again, and again, and again, and again for the next 7 years? I don't know, right? So like that strategy needs to kind of be baked in. Some red flags that would not that would make a pre-seed company not a pre-seed company that would probably make investors reject that. Pre-seed company that's trying to raise money to recruit a co-founder, big red flag. Why? Because your team should be formed already. You don't form a team because you have money in the bank. It's the other way around. You get money in the bank because you have a fantastic team. Um, you know, it's not easy to find a co-founder. It's not easy to find somebody who's willing to quit their day job and work with you on this product. It's not easy, and it's probably the first step that we have to go through. Anybody can come up with ideas. Much fewer people can recruit people or kind of form a team, a powerful team around those ideas. And that's a test that investors want to see you go through without their checks. Um, another red flag, no idea how to get customers, right? They're just product builders. When you have a team of 3 engineers that are just product building, but there's no marketing person, no growth, no salesperson, that's a flag. It's usually not as those skills don't tend to come together. Type of person that's really good at sales. It's not usually the type of person that's really good at coding. So like that's where you need, the different Steves in the equation. Or yeah, another huge flag is that you pitch this round and you've budgeted only getting to launch, right? You budget the round and say, hey, we're going to get the product to here, and that's it, and then we'll raise the next round because investors know they've seen this, they've seen how many companies launch and run out of capital after that. So make sure that the money that you raise is enough, not only to get to launch, but to get to seed stage, to start pitching investors, and then to raise the round, which is another easy 6 months, right? Raising a round takes about 6 months. So make sure that um, that money is enough to go through this entire journey and time to raise the round. Yeah, so rounds should last. I mean, people always say that, hey, rounds should last about 18 months. That's not entirely incorrect, but it's not about the time. It's about reaching the milestone, which tends to take about 12 months, plus the other 6 months to raise the round, more or less. Okay, let's do the next round, the next jump. So going from seed to Series A. So we established what a seed company is, great. So we're trying to get to Series A. Now, I always like to talk about this because this is where we got stuck. Like Slidebean as a company, this is where we got stuck. We raised a pre-seed round, we raised a seed round, and then as we were trying to get to Series A, we didn't get to Series A. And part of the reason, honestly, and I'll blame the lack of content like this. Everybody told me that I had to raise money for 18 months. I said, yeah, just raise money for 18 months of runway. And I'm like, dude, I did. I'm 12 months in after the round, and now I'm pitching you Series A investor. Well, that's great, but we're a Series A venture fund, and we invest in Series A companies. Series A companies have $2 million in annual run rate, not one. So yeah, we had around $1 million in annual run rate by the time we were starting to run out of money from the seed. Started doing the pitching, and nobody would take the meeting. Everybody's like, no, I get to. We're excited about what you're doing, but we need, we think you're too early. We need companies in 1.5, 2 million in ARR. So, again, what's Series A? Series A is $2 million in ARR. Traits of product market fit. So this really good understanding of the audience, this good acquisition funnel, this low churn, like high engagement, low churn should happen. To consider yourself a Series A company. Uh, Amazing understanding of metrics. You know your metrics up and down. The founders know their metrics. They understand how their sales cycle works, or how their marketing cycle works, or cost of acquisition. Um, there's a good established team that's already doing all of this. Maybe no rock stars in the team. Maybe you don't have any rock stars yet. You haven't had a lot of money, but these are rather junior people that have been able to prove themselves in the growth that this product is experiencing. Red flags. Um, like I said, just raising money for 18 months and not reaching that, or red flag that would not qualify you as a seed company is trying to raise money with a product that's in the market, but that has no revenue. Think of investors as think of the FOMO that you create for investors, right? In the end, what you want to do is you want to convince this investor that they need to put their money in now, because otherwise somebody else will, and they will lose on this amazing 30x possibility to multiply their money. If you're a seed company, I'm sorry, if you're a company and you launched a product and that product isn't growing, um, then the problem with that is that investors have all the power, all the leverage in the world. They can just wait and see what happens with the product. They don't need to risk their money. They can just even closing around, going through the due diligence, going through everything. It's going to take months, right? So even if they're very excited about the product, they might give you follow-up meetings. But what they're really doing is they're just waiting to see what happens. And if 3 months later the product isn't growing, it's like, well, something's off, right? So very crucial. Uh, you have to get to seed before you pitch invest. I'm sorry, you have to get to seed metrics before you pitch investors. Okay, let's do one more. Let's do the jump from Series A to Series B. We haven't raised in Series A. I don't think we will. But I've worked with a fair share of companies that have. Some Series Bs too, but Series A's. Again, 2 million plus in ARR. Traits of product market fit, fantastic understanding of metrics. Series B, what you're trying to get to is $5 million in ARR. You're after Series A, because these rounds are big, right? Series A rounds are easily $5-8 million. Like there's cash, there's real cash in there. You're gonna have the money to recruit a senior exec team. You're gonna have money to recruit a really solid, powerful team. So you want to make sure that that team is recruited by the time you get to Series B, and you should see early traits of exit strategies, right? People ask often, like, do you need an exit strategy slide on your pitch deck? I don't think you do, because nobody, at seed stage or pre-seed stage, nobody really knows what's going to happen. But at this point, yeah, exit strategy slides tend to be more useful. Like, are you going? Is your intention to go public, or is your intention to sell? If so, that should happen probably soon, right? At Series B, your company has been running for 4 or 5 years. So who are you looking at? Who you're talking to that might become a buyer? Red flags. Again, we got stuck here. Not enough revenue. Running out of money before reaching the milestone, or just not understanding growth. Oh man, that happens more often than you think. Just a company that doesn't understand growth. RevOps, which is a thing now. That's the name that the startup world has come up with for this thing. It's RevOps, this team that makes sure that understands metrics, growth, so that sales, growth, marketing, customer success, retention, like this all put together. Chief Revenue Officer, Revenue Operations, that's the name of it if you're trying to recruit that. But you have to understand your KPIs. And it's not easy. You need a lot of people. It's a team effort, or at least a multi-brain effort to do that. Okay, those are all my slides. I wanted to make sure I left some time for questions. But first, 2 quick commercials. One, like, this is our main Slidebean channel. Thanks I see a bunch of people. Man, so many people. We always get so many people on these live streams. Thanks. yeah, this is our huge channel. We do a lot of videos now. We've been around for a long time. But we started a new channel called the Startup Club. It's been around for about a year and a half. It's like the deep dive startup channel that we've made. It's yeah, like every deep dive startup video on raising money, convertible notes, cap tables, financial modeling, how to understand how to budget these rounds. We have a lot of content about this on the Startup Club channel. It's much more nerdy, much more niche than the main channel, but maybe useful if you're in today's live stream. So that's one. Also, we have a budgeting webinar tomorrow. You can sign up directly on the channel. We are gonna actually build a financial model for one of the companies. We don't really have time to build two or three models for people that join the session. So if you're interested in that, if you're in the Zoom link, you can just go to your Slidebean app or wherever and sign up for tomorrow's session. Also free. If you're in the YouTube live stream, you can also watch. If you want to, maybe ask questions directly or interact, or if you want us to kind of build a simple model for your company tomorrow, make sure that you sign up for the Zoom link as well, because we can't do it over chat, over YouTube live stream chat. But yeah, that happens tomorrow. So that's commercial one. Commercial two, again, Slidebean is not just a YouTube channel. We do a bunch of other things, and our platform, our SaaS platform, is a platform to help founders raise. So we have a pitch deck builder, we have an investor finder, we have a cap table, we have a financial model, and one of our plans even includes monthly 101s. That's actual 101 time with our team to go through your pitch deck, to go through your financials, to get budgeting right. So you get one monthly call with our pitch deck team, one monthly call with our financials team, and a kickoff call with me. So I talk to every single company that joins our Accelerate plan, so Slidebean Accelerate. Um, we do think of it as like an accelerator, if you will, where we kind of work. We use these monthly syncs. You have access to all of our tools, of course, all the SaaS tools. We have a bootcamp on financial modeling. You have access to all of that. But more than anything, you have this one-on-one time. Companies tend to stick around for 4 months-ish on the Accelerate plan so that they can get their pitch deck together, get their financials together, and so on, and begin pitching investors. So if that's interesting, you can sign up. My team I will sure my team pastes the link in both chats so you can sign up for Slidebean Accelerate. All right, now it's time for questions. So I'll stop this screen share, and I'll move this thing up here so I can read both of your questions, or all of your questions. And yeah, let's start. I see you, Div. Okay. Could you talk a bit more about budgeting? I mean, we'll talk about a lot about it in tomorrow's session, but I'd say biggest takeaway there is just ensuring that both a combination of expenses that you're accounting well for every expense, and that you're really accounting well for revenue, right? Like that you understand how much revenue is going to cost. So revenue costs money, and you have to spend money to make money. You have to spend in ads or in sales, so you have to understand how much that's actually going to cost. Will this recording be on YouTube? Yes, it will. It's always on our YouTube channel. We always keep the last webinar there. Okay, let me take one from YouTube. I'll start from the top. I see Costa Rica. Hey, Costa Rica. I'm Costa Rican. Most people don't know that, but I am. Good place. I live where you guys vacation. Okay. Pigeon Post. Beware of terms if you get acquired. Oh yeah. It's a warning. Fair. How do you position a company that's part infrastructure, part technology to raise capital when most investors focus on one or the other? Yeah, that's a good question. It's a good question. I think it's a question of scale. Like how quickly does this scale? Like if you say infrastructure as real estate, tech investors tend to hate real estate. It's a very slow to pay outcome, right? If it's think about what I said before about exit outcomes and time to pay back investors, because I think that's kind of what determines if you land on one group or the other. I think. Yusuf, what percentage of equity should typically be allocated in pre-seed seed rounds to maintain founder control while attracting investors? Good question. We made a great video on this, and I don't want to take all the credit. We made the video, but this is based on a research on a study that Carta published. It's called how much equity do founders still have after the last video on our Startup Club channel. Josh, if you don't mind, can you find that and paste it in the chat, both chats? I think it's a fantastic video. it kind of goes through the process. How much equity do founders usually have at the different rounds of funding? Most rounds of funding end up taking, in the average or in the median at least, end up taking about 20% of equity. Funny enough, by Series A, most founders will no longer control 50% of the company. Um, and that's normal, that's just standard. People worry so much about control. Oh, I'm going to lose control of the company. If you're in the venture capital game, that's going to happen. Uh, and losing majority doesn't mean losing control of your company. It's an important distinction, but that's just how it is. Yeah. Again, it's a good video, but more than the video itself, it's a great study, and I break it down a little bit. Okay, so let's see what's the next one. From YouTube. Sorry, I'm doing it on my phone, so it's tiny. Sorry. Uh, what metrics could VCs want to see from a startup in the retail hospitality sector beyond idea conceptualization when considering pre-seed round of funding? Well, if you're considering pre-seed, there are no metrics that you can share, right? You don't have metrics. Um, you can show comparable companies. You can show a little bit of that, but metrics are only a question after seed. It's a hard question to answer because the metrics that matter to a company are very different, right? For software, it's like engagement time on site. For real estate stuff, it's probably something in the lines of occupancy. Profit margins, I guess, are much, or gross profit in tech is almost irrelevant because if you're selling software, your gross profit is always going to be positive because software is just very cheap to operate, not to build, but to operate. Whereas in retail, I'm sorry, in other businesses, uh, you know, gross margins against cost of the team, cost of operations tends to be smaller. So maybe that's another metric. But this is it varies a lot from company to company. I'll take another one from Zoom. For a pre-seed, pre-revenue startup, how long of a financial model is necessary? Great question. We're going to talk a lot about that tomorrow in the session. So Nicholas, if you want to, good idea for you to tune in tomorrow. I'd say that uh, I have this rule, which is that normally investors in a pitch deck want to see a 5-year forecast. 5 years is a good amount of time to understand if you're being aggressive about growth, if you're seeing if there's this real vision to scale fast, right? If that's happening. So 5 years is important, but I like to think, or I normally recommend spending 80% of your time budgeting and forecasting for the next 2 years, and 20% of your time budgeting and forecasting for the 3 years after that, right? So 80-20 on 2 years versus the next 3 years. Why? Because the next immediate 2 years are very, very close, right? They're right there, right? You're going to have to hire people. That's 6 months from now, 12 months from now. It's very soon that you're going to have to deal with this thing. So you have a lot of visibility on what the company needs. Whereas you don't know what's going to happen, right? Like 4 years from now, you're not going to be forecasting whether you hire a CMO in January versus March because, like, who knows, right? It's so far away. So I think the investors understand that. So 80, I mean, the section of your financial model of your forecasts that they're going to be funding, which is the immediate next 2 years till you raise the next round. Uh, that needs to be super detailed. Uh, that's not to say that the remaining 3 years in the model are irrelevant, right? Because your company grows really fast during those 2 years and then flattens out. It's like, oh, these guys are not being aggressive, or they're not thinking about growth after that. Or if your company just creates this astronomical growth that gets to billions of dollars, it's like, oh, these guys, there's some weird metric in this financial model because something that they're estimating just doesn't make sense, right? So those are the first flags or the first things to check that those assumptions are realistic, not only in terms of how fast growth happens, but also that the team creating that growth has been accounted for. Awesome. Okay. I see you. I'm an entrepreneur from South Africa. I don't have a question. Just want to thank you for the material. Oh, you're welcome, man. Happy to be useful. Norbert, that's what pitching investors should begin. However, even after a successful pitch, the actual money from seed investors often arrives 4 to 6 months later due to bureaucracy. Yes, that's true, man. People don't believe me, man, when I say this. It's like, oh yeah, yeah, I have this investor that's we yeah, some of we no, sorry. We do some one of our subscriptions includes us building a financial model for people. I'm not trying to sell you that. I'm just using that as an example to say, I see all these companies that I chatted with this week. They're like, oh yeah, we have this investor that we're talking to. There's one investor that we're talking to. So when do you expect to close your seed round? Was my question. Oh, we're talking to this investor. We expect the seed round will close in August. I'm like, dude, there's no way you will close that round in August. First of all, the bureaucracy, the due diligence, checking of your legal paperwork, and reviewing and negotiating terms, that takes months. It doesn't take months of time. It just takes months of back and forth, right? It's not that you're going to be grounding down for months. It's just back and forth between lawyers and a bunch of different players. So it's going to take a lot longer. Problem one. Problem two, I also didn't believe this at first. I got this quote um, from one of our it was one of the managing partners at we did 500 startups, which is this accelerator in Silicon Valley many ages ago. Um, and when she came out with this line, I'm like, this has to be wrong. Elizabeth, she said, she runs a fund now, by the way, it's called the Hustle Fund. They invest in very early stage companies. But what she said is like for every $500,000 that you need to raise, you need to pitch about 100 investors. And I'm like, this can't be true, man. How can I be? I don't know, I'm raising 800. Do I need to pitch 150 investors? That's crazy. Where am I going to find 150 investors? That's so much time, so many pitch decks sent. It's prophetic, man. Biblical is what Oasis would say. Uh, when we finished our round, when we closed it and cashed him in the bank, my spreadsheet with investor relationships had 142 people in it. 142 people that we got an intro to, sent our pitch deck. Uh, Not everybody turned into a conversation, as in a call or meeting. It was pre-COVID, so most of that was meetings, not calls. But but yeah, 142 people. So it takes it's a painful effort to raise money. It really does suck, and that's why I call it. The name is not a fake thing. So it's gonna take too long. Like and yeah, another mistake I think I see is like, hey, like you put all your eggs in one basket. You see there's one investor that is maybe interested, great, follow up, but you still need to contact 149 more um, to close that round. And your round's gonna be closed by six of those 150 investors, but it's a lot of people and it's a lot of time. Okay. Um, like starting a new startup today, what would it be? I don't know, man. If I had a new startup to start, I would probably start it. I don't have I don't know what else I do. I enjoy doing what I do today. Keep doing lives. I love them. Him. I'm happy. I'm glad that they're useful. I'll take that. We have another one on this main channel about kind of like marketing and kind of YouTube channel building. So a bit broader than what we're talking about today. But yeah, stay tuned for that. We'll announce the new dates today. Um, sorry, tomorrow we'll announce the new dates. So if you're in the seed stage, seed investors typically arrive in the second half, not at the beginning. This timing shift could be factored in already during the pre-seed phase. Yep, that's true. I see your info. When you're submitting to investors, when I submit my business plan, other than my pitch deck, or should I just submit the pitch deck? That's a good question. Great question. Um, the pitch, what's a business plan, right? Let's first get on the same page about what a business plan is. A business plan is all the ideas that you have about how you're going to execute in this business. You take all these ideas that are in your head and you put them into this formal 40-page document that you call a business plan with breakdowns and financial forecasts and go-to-market plans and so on. I had to write one when I was getting my visa, my L1 visa. I needed a business plan, so I had to write one for Slidebean. Uh, and it was a visa thing, so I didn't want to. No, there was no GPT back then, so it's like fine, I have to actually write this thing. So I did. It took me weeks of work to write this business plan. And by the time I was done with it, everything had changed. Like our go-to-market had changed, our forecast had changed, what we were doing with the product everything had changed. So I think the problem with the go-to-market plans is that they take so long to write and startups change so fast that it's never going to be up to date. So I think business plans are completely useless. Period. End stop. I think they're useless. Uh, some banks will ask for a business plan. Investors, like tech startup investors, will absolutely never request a business plan because it's just stupid to have someone write that. And then a pitch deck. it kind of operates as that, right? You're taking what's the pitch thing? Well, we're taking all the ideas about what you want to do with the company, where it's going, how big it's going to, how big this is going to get, your TAM and your go-to-market strategies, and you're putting them in this 15 or 20 slide document that takes, a few days to make, definitely not weeks, right? And that somebody can read in 4 minutes. Whereas the business plan, I think realistically, who reads a business plan, man? Like, are they really like reading through 40 pages of documents? That's like a book. No, they're probably kind of skimming through, right? So like let's skim through in a skimmable format, like a presentation, and not in a business plan. That's what I think about business plans. And I think, yeah, I think that for starters, they're they're not needed or useful. Okay, sorry to break a bubble. Um, can we start paying our CEOs with seed funding? Will investors mind? What's the limit amount of pay our CEOs to keep spending? CEOs, so your chief people, your founders. I don't know if we're talking about the same thing, but um, I wouldn't say that the salary of the founders is a percentage of the round. That should never be the logic. The salary of the founders should be enough money, should be some rules. Less than the market salary for the job that you're doing, right? So if you think how much does the CEO of a 10-person company make? This, okay, it's less than that, right? So that's one metric. How much does a CT full stack developer make? Whatever you're paying yourself has to be less than that. So that's one rule. Um, I don't want to say half. It really depends on where you live, but less than that. And I'd say the other, whatever money you're taking from the company is kind of like shortening your runway in the end. It shouldn't be enough money to save much. It should be just enough money to get by, right? Because the real value, like investors want to see you not working to keep the lights on. They want to see you working to grow the company, to get paid. The real fat check, which comes if the company gets acquired. So whenever you start paying yourself too much, that's a risk. I've seen it. I've seen financial models that people make, and they put $300,000 as their entry first salary after they raise a round. And like, dude, that's just nonsensical. Because they see some CEO that makes 300K a year, and they're like, oh yeah, that's what I'll pay myself. No, I mean, and I guess it changed a little bit with age too, man. Like when we started this company, I was 24, 25, 24. Yeah, like all I needed then was just basic food and stuff. Now I have a family, I'm getting married. So I like investors will understand if you need to make more the older you are. I have kids, okay, so like that changes with time, but it's an unspoken rule that the older you are, you probably the more you have to pay yourself. But also it kind of connects to market salaries, right? So people as they get older, they have more expenses and so on. Okay. Um, Couldn't find the webinar link for budgeting. That'll happen tomorrow. Can we please share? Yeah, team, can we please share the link to tomorrow's webinar? Should be on the Startup Club chat. Okay, see more questions on YouTube. I got to the half hour, guys. So here. Thanks for the congrats. Okay, I'm based in Europe. Already raised around in here. Any advice on how to raise money in the US? Good question, man. Like the US is a mess right now, but not so much for funding. Um, I think the main disclaimer I'll give you on US capital, like many of our investors are from the US, but the main disclaimer I'll give you is don't assume that you can raise money in the US just because you set up a Delaware C corp. Uh, you raise money in the US if you're targeting US customers, if you have a strong US presence, if you have a strong US network. So for European startups that are mostly operating in Europe with European customers, why would you go to the States? I mean, why would you raise money from the States? Because there's more money there? Yeah, I guess, but uh, uh, it's much more about where you operate and the market that your investors understand, and your network. So like you can perfectly, I mean, there's enough venture capital in Europe to throw around. No need to raise money in the States unless there's an intentional uh, uh, reason why you have to be there. And again, in that first mantra I told you about, it's like I see founders like, oh no, I'm just going to go to the US. I'm going to move to the US so that I can raise money there. It's like, well, that's the worst reason to move to the States. Uh, you move to the US or you move operations from your company to the US if it's worth it for your company. And then you raise money there because that's where you are. It's not the other way around. You don't do things because you expect investors are gonna like them. That business strategy. Okay. Um, during seed rounds with only a team of two, how exactly would you keep investors involved in your team if you're would you keep investors involved if your team's not that big? I had this dream too, man, that investors would be very involved. Like you see that, oh, smart money, raise money from investors that are, I mean, yes, true. Or raise money from investors that will help you, that will provide, I guess true, but my expectation was very different. Like my expectation was like my investors are gonna buy my product for their own companies, right? Like they're gonna have everybody use it because they invested in this. No. Or they're gonna carve out hours of their time to help me and introduce me to people. No. Investors save maybe, if you're lucky, 1 hour a month for you because you're just one of many companies that they have, and your check is one of many that they wrote. So they're not as invested in the companies that they invest in as you might think. So you can snatch a few minutes, an hour a month. I'd say it's a lot from them, but don't assume that they're gonna help you solve any of your problems. They're very much expecting you to do that without much of their involvement or help. Okay, Brian, I'm a designer at retail hospitality, 3.4 billion in revenue since 2010. Holy shit. For my startup in the same industry, should I leverage operational expertise? No, yeah, absolutely leverage operational expertise, man. I would, I would brag about that. I would brag about that all along. I mean, you're a designer. I don't know if that gives you operational expertise in the industry. You've been in the industry, but yeah, I would leverage my. I mean, I guess it's a related note. Like, uh, the ideal company, the ideal team is a team that has industry knowledge, right? Like, I started a presentation company. I guess I had a little bit of experience because I mean, I studied digital animation, which is kind of storytelling, which is visual storytelling in a way, right? So we're kind of adapting that to presentations. I can kind of say that now, but I didn't have a lot of extra expertise on like building software or building productivity software for companies. I didn't know any of that. Uh, and that was bad. Like that was a disadvantage. I think that made me a less fundable founder when we started Slidebean. So the more you really understand the industry that you're starting a company in, the better. You normally want to start the business opportunity that you found. You normally find it because you've been in this industry. If I were to go and start, I don't know, social media company now, it'd be a lot. I guess that's not too bad. I guess YouTube is social media. I'll say enterprise, right? If I were to start an enterprise company now, I've never worked in enterprise. I've never sold to enterprise. I don't understand enterprise. Why would I be a better founder than the next guy? So it's important. That's important, and I think you should always leverage that. And I think at least one of the founders should have a good foot in the industry. Hey, from Chile. I live in Santiago, man. I did start in Chile back in 2014. Lived there for a few months. All right, Captain. Will this live be available? Yes, it's gonna be hosted on the YouTube channel. All right, looks like we're running out of questions, guys. I'll give you a couple. I'll do some small talk for a sec. See if anybody else throws anyone. Oh, there you go. During startup, is it LLC okay, or would you recommend changing to a C corp? Good question. We have a little video on that too on the Startup Club channel. Um, so LLCs in the States are very useful to start because they have a lot of tax flexibility, but LLCs are absolute dog shit for uh, tech companies that are the reason why I'll get a little technical is that an LLC, what rules an LLC is this thing called the operators agreement, the founders agreement, that says, okay, this guy owns 10% of the company, this guy owns 50, this guy owns this much, and sets the rules for how that plays out. So if you want to bring an investor into an LLC, the LLC needs to be redone, basically needs to be recreated from zero, create a new operating agreement with a new share distribution, which is bad, uh, which is just a lot of work. Whereas in a C corp, you establish the C corp. This is the company. This is the amount of shares that it has. And then when a new round comes in, oh, like we're actually going to create a new batch of shares for that investor. So we're going to issue shares to this investor, but everything else stays the same. We're just issuing shares. So that's a lot simpler, cheaper, um, easier, logical, because you don't have to restructure the company from scratch every time. You can also do stock options for employees. You can go public. Shares can be exchanged by people. So like that's why startups are C corps and not, or venture-backed tech startups are C corps and not LLCs. LLCs are good, if you don't intend to raise money. That's a much simpler, flexible structure for sure. Okay. Um, Looks like now we've run out of questions, which means everybody gets 10 minutes back. Yay. All right, guys. Thanks a lot for tuning in. Sorry for not the best set than usual. We usually have like a neon sign and everything. But we'll please remember to tune into tomorrow's session. We're going to talk about budgeting around some financial modeling stuff. Thanks everybody. I keep getting surprised that so many people still in the live. So thanks a lot for signing up and for sticking around. Hopefully I'll see you all tomorrow. Remember the session happens on the Startup Club channel, which is our second channel. So hope to see you guys there. Thanks.